All right. Welcome everyone to Fogel Potamianos presents the 2024 M&A and Alternative Investment Forecast, an all-star panel of hedge fund, venture capital, and investment banking experts contributing all of their insights and forecasts for 2024. My name is Christina Lowe. I'm the executive director here at Fogel Potamianos. I've also worked in television production, and I have a podcast with my husband called the DownLowed. And I am here to moderate this amazing all-star panel. And I'm going to go ahead and introduce our panel right now. First, we have Cesar Bello. He is a partner on the investment team at Corbin Capital, focusing mainly in litigation finance and private markets, dealing a lot in private credit. Corbin Capital has been around for 30 years, so there is a great deal of experience and expertise there. Welcome, Cesar.
Hi, Christina.
Hello, thank you so much for joining us. And then we have Alicia Zeng, who is the Director of Operations at Bay Area-based VC Pure Ventures, formerly McKinsey, Google, and she works primarily with early-stage consumer companies. In addition to that, she also runs a beauty e-com company where she is building an amazing brand and seeing success there. Welcome, Alicia. Thank you so much for being here.
Hi, everyone. Thank you, Christina.
And we have Jason Somerville. He's a founding partner of a boutique firm called GW Partners. He's also the founder of an incubator called South Call, where they invest in earlier stage companies and grow them to sell within a 2 to 3 year period. He has an amazing background as an investment banker. Then he was also an entrepreneur, and now he's found a way to marry those two worlds and bring that experience to us here today. Welcome, Jason.
Thanks, Christina. Excited to be here.
All right. And then we have our very own Constantine Potamianos. Good morning, Constantine.
Good morning.
Constantine has an extensive background in a mixture of things: technology, finance, law. He actually has started a few technology companies and spent most of your career, Constantine, between investment banking and corporate law in New York. And then you moved that to Austin, Texas, where he now resides, and he is one of my personal favorite people in the whole world. So very excited to hear from you, Constantine.
In the best Texas tradition, howdy y'all. So,
Sir, yes, sir. And then we have Jerome Fogel, also co-founder of Fogel Potamianos. He is known as the deal maker and innovator in the legal community, and he represents successful corporations, venture and hedge funds, and sports superstars. Jerome has a 360-degree view of deal making, and he represents emerging companies raising capital, venture funds deploying capital, advisors and investors, and private companies in mergers and acquisitions. Welcome, Jerome. How are you today?
Doing great. Thank you, Christina. Great to be here.
All right. We are so excited to get started here. I'm going to kick things off with Alicia. And just get right to it. Alicia, you're so involved in the private company and VC space, and would just love to get your insight on what you're seeing in that space, and maybe just what trends you're seeing and what you are seeing for 2024.
Yeah, definitely happy to provide some insight on that. I think I'll speak primarily to the venture capital space, and my area of experience here is really in the earlier stage venture capital space. I'd say that following the footsteps of 2023, we continue to see lower deal volume and definitely also lower valuations compared to the frothier side of 2020 and 2021, particularly in consumer. I think across the board, though, across defense, high tech, etc., we do see less deal volume and lowered valuations. I think there's been a renewed focus on, and I'm sure everyone's heard this time and time again now, a renewed focus on profitability, on extension of runways. I think anyone who can choose to not fundraise most immediately is trying to do that, to stretch out their timelines, to show more traction, to show profitability under their belts to do that. And so I think there's also lower deal volumes because the companies that are coming out and saying, hey, I want to raise money right away, a lot of those right now are companies that have to because they've run out of cash and they aren't able to fund themselves to provide more traction than they already have. So I think that it's actually overrepresenting, I think right now, like the weaker side of companies. But I think as the year goes on, and it'll have been closer and closer to maybe 2 years since a lot of companies raised at the like high times in 2021 and even like the first half of 2022, we'll see a more, I think we'll see a return to normalization of like deal volume, et cetera. But I do think that valuations, I don't see those changing and inflating aggressively anytime soon.
Hey, Alicia, quick question for you. In the VC space, to the extent that you're talking to colleagues in various sectors, what are you seeing as kind of the hot sectors right now that are attracting VC attention? And maybe given the diminished capital raising environment, what are the 2 or 3 top factors that folks are looking at in general with the opportunities that they're examining?
Oh, these are great questions, focusing on the positives. I mean, again, I'm going to say something that isn't going to surprise anyone. AI is just continuing to beat the drum. AI is continuing to foster excitement and dollars in a way that I don't think any other sectors are right now. And what I see to be the real opportunity in AI, I think, especially because it's a relatively newer field and there's a lot of companies that are coming up and are very young. I think in a lot of sectors, like I think we're yet to see who's going to really win particular industries and sectors within AI. But I think a sure bet is going to be AI infrastructure. So we're already seeing in the chip makers, like their stock values increasing. Any other AI infrastructure, I think similar to the boom of direct to consumer, say in like the late 2010s and like 2021, 2020, that time, it was like you had these individual consumer brands and people were putting chips on each of the horses there. But like the ones that would win no matter what were like e-commerce infrastructure. I think you're going to see something parallel there for AI as well. That's my take.
And then within, I mean, there's traditional factors that VCs will typically look at, the financials, the fundamentals, kind of what their run rate is, how much cash they have on hand, what kind of revenues are they bringing in or projected to bring in, what the team is looking like. But out of those, are there 2 or 3 things that you guys are focused on in particular in this tighter capital environment?
Right. I think we've still got the same basics that we did before, like the same basics of traction with users, scalability, by NPS scores, especially on the consumer side. But I think that there is more emphasis than there was before on unit economics and runway.
Okay.
So I think especially if you can pair unit economics with scalability, like that's more of a magical formula. Whereas I think beforehand it would be just scalability alone and trusting that you could just pull more money, pull more venture dollars, or like raise very, very cheap debt to fund that growth. I think now we're also asking the question of like, you have a path toward growth, but can't you also have a functional path to fund that?
Yeah, really kind of an emphasis on being able to self-sustain and when that's coming. Okay. Thank you.
Of course. I will say another pattern that we have seen on the VC side is as companies that are coming to the fore now to recapitalize, especially those that are coming because they really have to, I am seeing more instances of I would say aggressive deal restructuring. So I've seen pretty aggressive recapitalizations, et cetera. And so I think that we're going to see some early investors have to make hard choices and potentially get washed out, especially in down rounds. So I think that would be something to be careful of.
Do you think this is also partly affected by the difficulty or I guess it's a 2-part question. Amongst your colleagues, are you seeing increased difficulty in terms of fundraising from the fund side, from limited partners, et cetera, for new funds or funds looking to increase? And is this then translating into being more conservative or aggressive in terms of terms that the funds are putting to potential investments?
The second part's interesting, but I can very easily answer the first part. And maybe Jason can speak more to this on the private equity side, because I think something similar is happening on the private equity side. But in venture capital, like it depends on a virtuous cycle of funds exiting, giving LPs capital, which they're
Right.
then excited about, happy with it, that they're then putting into new funds. And because distributions have really been slowing down from VC funds, that's like putting a pause in the cycle. And I
Yeah.
think that's creating this like long drag of LPs not having liquidity to then put into new VC funds, which is kind of a shame, because that's you want to be putting in money when valuations are lower, so you can capture more of the growth later. But then we've got a situation in which investors don't have that liquidity to start the new VC funds. As to the second part of your question on how that flows through to terms that VCs are giving to companies, I feel like that's hard to extricate from other macroeconomic factors.
Yeah.
But like I alluded to earlier, I think valuations are tighter. And so I think that's the most visible way that the terms that investors are bringing forth have tightened.
So Alicia brought up a good point, and maybe I want to point this to Jason or Cesar, but what we all know of is that IPOs kind of scaled back in 2023, which has been a traditional exit scenario for VC funded companies, though, you know, it's come and gone over the years. Jason, are you seeing increased activity in the private equity exit space, other liquidity options for some of these companies besides the traditional public markets?
I mean, I think the choices are the same as they've been. I think you've seen a little bit of a shuffling of the deck. I think you're right. IPOs are down, but exits across the board are down. I think that there was even reading an article today about how there's a lot of GPs in the private equity world looking at selling stakes, kind of in the GP, because of that, because of the lack of, say, exits that have been occurring. I mean, we've definitely seen a little more kind of private equity to private equity type transactions where, companies are changing hands. Usually it's an upstream, typically type of, exactly. So, but in terms of appetite, like I think the LP appetite to put money into private equity is as strong as it's been. But I think it just comes down to, the ones that have been able to perform are able to raise new funds, and the ones that, haven't really aren't. And I think that a lot of LPs, because of the, I'd say, acquisition market was so, I'd say, sluggish last year, they also want their money to be put to work. So you have funds that are kind of sitting there, they're starting to age a little bit, and there's some decisions to be made. I think this year it's one of the potential driving factors in the market for the year is money that's been kind of getting a little stale from LPs asking the GPs if they're going to be able to put this to work or not. And if they're not, then they may want to put it elsewhere.
So shifting from the VC to the private equity market real quick. So what do you think kind of addresses why the acquisition market was sluggish last year? And what do you think, to rephrase the question that I asked Alicia, are the top 2 or 3 factors that make an acquisition candidate most attractive in the private equity sector?
Yeah, I think last year was pretty simple. I mean, we had inflation and we had uncertain, I'd say, macro outlook, and those were the 2 biggest drivers, right? With kind of the Fed in there creating, just uncertainty as well in terms of, where were rates going to ultimately go. So I think those were the really biggest drivers of lack of activity. And I think also as M&A always runs in cycles, because you always have to have, willing buyers and willing sellers both having similar views of value. And so when you're coming off like such a record valuation, record volume period like 2021, it takes a while for everybody to catch up in terms of those value expectations. So, similar to what Alicia was saying, I think the themes now, I mean, look, quality, it's kind of quality is a big one. I think, there's an extra focus on, the quality. I think that top quartile companies, it's something we kind of a phrase we say a lot, top quartile, there's good deals to be done for those companies. I think outside of that, it's a struggle. It's a valuation struggle. It's also a struggle to really have a depth of potential bidders. So, and quality is measured different ways across different sectors. But I think, as Alicia said, profitability, sustained profitability as you scale, and that ability to, and kind of showing that ability is really a big driver at this point, which, is very typical for M&A cycles. We're in that part of the cycle where people don't want to overpay, they don't want to get over their skis, and they want to see you prove things before they're willing to give you credit for them. If you can prove them, you will get the credit, but there's not going to be a lot of speculating going on of if you can prove something, that it's hard to determine from past evidence that you definitely can.
Okay.
And I would add, relatedly, the interest rate environment has a lot to do with people's appetite to look at venture and private equity companies. Cost of borrowing go up. Those models get a lot harder to justify sort of, the performance you've seen in PE and VC going back 10, 20 years. So now the Fed has signaled that rates are going to come down. Sentiment has changed. People are feeling good. Markets are at all-time highs. But, now they're kind of walking that back a little bit. Maybe rates are higher for longer. Maybe some stuff starts to break. You still have a very uncertain geopolitical situation. I was just at an event John Bolton was speaking at, and Russia, Middle East, you pick. There's I would say cautious optimism, in part because of the macro backdrop, and uncertainty around, kind of what shoe can drop this year.
Yeah, you anticipated my question, Cesar, because I was going to turn next to you and say, look, you guys have your fingers in so many different pies and aspects of the economy. I was going to ask for your perspective on it, which you've brought to the table. Where do you see right now amongst your diverse activities, and you may want to tell the audience a little bit about all the things that Corbin Capital is in, where do you see the highest opportunity and the higher growth over the next few months?
Yeah, so next few months is tough, but maybe a little bit of a longer market cycle.
Sure.
I would say, so for Corbin, we manage $9 billion across multi-strategy book and a credit book. I focus more on the credit side. Private credit is sort of in vogue right now. I am talking my own book here, but I think given all that uncertainty, you want stuff that is uncorrelated to the markets. Our best performing sub strategy within credit has been litigation finance, which I manage. That's investing in legal outcomes, which are truly uncorrelated. And if you're building the portfolio correctly, the positions within the book should not rise and fall together. So you have, I would say, true diversification, and the combination for sort of high return potential. So, it shouldn't be a majority of your portfolio necessarily, but 5, 10, 20% and stuff that is truly untethered to any sort of, Cold War, hot war, cyber war, geopolitical event. interest rate environment, et cetera, I think makes sense. And, we're launching a fund the next couple months and seeing a lot of interest from family office and sort of endowments and folks who want to swing hard, but also wants a differentiated sort of strategy.
Cesar, how
Right.
does the interest rates affect the private credit? Because it's been so hot, and obviously, there's shadow banking going on where banks are getting involved in these funds and P's getting involved in private credit. So how will the interest rate environment, let's say if it comes down, how would it affect the kind of steam the private markets carry, or is it going to continue, do you think, when the interest rates they do change?
So typically, if the base rate has gone from 0 to 5% in a year and a half, 2 years. That's good for private credit, right? So, your average deal should clip a higher coupon because everything else has gone up. But with the markets tightening up, access to credit has sort of dried up a little bit too, right across the board. There's a lot of private credit's a broad term. There's, you can do sponsor lending to companies do 100 million EBITDA. You can do lower market lending. You can do venture lending. You can do specialty finance, asset-backed lending, litigation finance. So it's tough to answer for each pocket, but I would say generally now we're seeing great deal and risk reward in private credit, and you're getting paid for it because people kind of need capital and, there's less of it to go around. But the other side of that is a lot of money piling into private credit because it is en vogue. Eventually, I think that's going to sort of impact pricing, and maybe people are going to start to do stupid things around covenants and a little bit of a race to the bottom to sort of win business. So, I just go back to the cautiously optimistic theme around all of this.
Cesar, one of the factors I think behind the growth of private credit has been kind of I won't necessarily say the shakiness, but kind of the pullback amongst the banking sector and concern about some of the assets they already have on their books, which has made them more reticent to be free with their capital, which has allowed private credit to kind of grow as well. Do you see any of that changing in the next couple of years?
Yeah, there's an article this morning on Bloomberg about how some of the banks are trying to come back and recapture some market share. The loan market and the high yield market. Maybe that'll start to happen. I do think a lot of the banks have retrenched with everything that's gone on.
Mm-hmm.
But you should expect, I think, some reaction from the banks at some point. There's also a lot of people piling into private credit right now. So I would just say, be careful because people are going to chase where they think they can raise money, and that's certainly the hot area of the day, right?
Yeah. What let the record reflect that Cesar's sector is the best performing sector within Corbin. But that aside, what other areas do you see growth in?
So we're seeing a lot of stuff, sort of back to Alicia's comment about AI, financing around data centers and chips. So, there used to be a bunch of data centers supporting Bitcoin miners, let's say. Now that's sort of flipping to AI kind of GPU capacity. That seems to be getting a lot of attention. We're seeing a lot of deals in that space. Not surprising. That space needs capital. But is it too frothy? Are people again piling into something super trendy? We'll see, right?
Okay. Yeah. Now we've also seen, over the last few years, everybody talks about a little bit of a decoupling of the global manufacturing chain, et cetera. And we're seeing some of it come back to the US whether it be on a large scale like semiconductors, for example, or on a smaller scale. And I guess it's on the smaller scale that I would ask Alicia and Jason to see kind of what they see in the actual kind of day-to-day manufacturing sector, if they're dealing with companies in that, whether it be CPG or whether it be small scale manufacturing. What are you guys seeing in terms of what we have coming back onshore and how that's kind of working out?
Yeah, I guess I'll jump in there first and then throw it to you, Alicia. I think on our side, we still hear a lot of talk and not a lot of action, I'd say. You know, we work a lot, obviously, in consumer, and in terms of and work across the product, say, spectrum. And I think that, you know, you hear a lot of people talking about, you know, changing up their supply chains, you know, maybe moving out of maybe a Chinese kind of focused supplier base, moving to something a little more diversified. I mean, the macro data certainly shows that the Mexico, I'd say, centric activity is picking up for sure. We haven't seen it a lot just across, again, kind of the companies we talk to, which is mostly lower middle market consumer brands. But and I feel like it's been kind of since all the supply chain disruptions around, you know, after COVID, a lot of the talk has started. It continues. So I think it's a focus. I think there was even, I didn't see the exact headline, but I think there was even another Donald Trump kind of headline recently, you know, sort of saying if he were elected, he would kind of up the ante again, kind of against China in particular from a tariff standpoint. So, you know, I think we're mostly still seeing talk. I know the macro data says the Mexico kind of nearshoring is real, but we're still not running across a lot of companies that have actually started to take real action to move. So, Alicia, I don't know what you're seeing.
Yeah, agree, seconded. I think that I know for my company, we're building into our risk plans the potential of aggressive, like universal tariffs on Chinese goods, but nothing's been put into action yet. I think since ocean freight costs have come down post-pandemic, and also given the strength of the US dollar right now and some deflationary pressures in China, that right now the price is just too good. I think that those tried and true, you know, China to US global supply chain troughs are continuing to be run, and will continue to be if and until like prices or logistics make some market change. And I don't think that's happened yet. So I would say I imagine it's in most companies' risk assessment strategies, but not yet being acted upon.
Sorry, I've been hogging the questions here, Christina. It's
This is perfect. This is perfect. Thank you. No, it's great because this is your world. So you're keeping the conversation going. And I love that. Jerome, you had some great points as well that you had mentioned in your food for thought. So would love to hear your insights as well. Get your thoughts on some of the things that are going on right now in this way. Uh-oh, I think Jerome's frozen. Is it me? Oh,
I think he
No,
froze.
no.
Yeah.
I think
Yes.
He did.
good. Okay. He'll be back though.
He's still ruminating over all the points we've thrown out here.
Oh,
So
there he goes. He's back.
You know,
hey.
technology is so much fun. No, I just think, you know, I think that you on the broad scale, the market is really choppy right now. So the private companies and funds that are the most competent and innovative are going to find a way to thrive in the day. So I just think, you know, what we're seeing is, you know, GPs going out and raising capital. It's to raise new funds. It's just taking longer. But the ones that are seen as the most competent, most innovative, they're attracting interest. And then I think especially too, LPs who have been in the game for a long time realize if they can get in with the fund one, they have the best chance of being in there for fund 2 and 3. Because what happens is, you know, they come into fund one, if it's really successful, they'll, like as Alicia was saying, there's liquidity. A lot of times they may just roll it over into fund 2. And so then what happens is fund 2 pretty much is supplied with capital from Fund One. So if you don't get in at the Fund One level, you may not like Andreessen Horowitz. It's good luck trying to get into one of their funds. The guys who are in their funds were in there from the beginning. So I think that really what that means is you really have to understand the deal environment, understanding that institutionals have less money to go around and diligence things. So like Jason was saying, like it's kind of a prove it thing. So you really got to show a track record of success. You've got to show the numbers. Like obviously, Cesar's in terms of litigation finance been doing this in this environment for a long time and understands the market really well. And I know he's even had, they've had to take over companies he's gone in and having to oversee, massive restructuring. So he really gets the market really well. So I think that's really the first point is if you're a GP out, raising, yeah, it's a tough environment, but if you've got all your ducks in a row, you're going to attract capital and people want to get in there early. And then I think too, you just have to, if you're an emerging fund manager, you just have to be flexible. You got to be creative. You got to inspire confidence. There's a smaller pool of capital out there. I do think family offices, they retreated a little bit last year, but they're kind of dipping their toes back in. And I think the T-bill and chill, which is basically taking, the treasuries I think it'll fall out of favor once interest rates start to fall a little bit. And then, cash will be less attractive and they're going to put their money to work. So I think that's the first point. And then also, Alicia had mentioned, there's going to be companies that are just going to die out because they're not going to be able to attract more funds. They thought, they're going to have an endless runway. So you're going to see some private company deaths, happening, which is really sad. It's really unfortunate. But ultimately, if they can't attract more capital or if they can't become cash flow positive, they just won't survive. Same thing's going to happen with funds. There's some zombie funds out there that aren't attracting additional capital. They don't have liquidity, so they're laying off people and they're just kind of sitting out there. So I think you're gonna see some turnover in the first half of the year, and so I think there's going to be way more action this year. It's not going to be 2021, but it'll be way more. It'll be far more active, and I just think that it's just going to be choppy market waters. So there's going to be a mixture of hesitancy and activity. And I think that, again, the most competent, innovative parties are going to win the day here.
Oh, I'm sorry. Go ahead, Cesar.
No, I was going to say, I mean, I think Jerome's onto something. I mean, I think the sentiment is changing a little bit, and it's going to be a better fundraising year than last year and the year before. People have seen the market run up, and a lot of people miss that. So there's a little bit of FOMO, just a little bit of, psychologically, everybody feels better when that's happening, right? So now that could change. But again, I think cautiously optimistic for this year, generally, from fundraising perspective, market perspective, all that.
Now, I will say one thing. I'm gonna go from the high level that we've been discussing and get down into the weeds for a second and see if you guys agree. Particularly in kind of a tougher environment like we have now for some of these companies, like potential restructuring things, potential more conservatism when it comes to making investments. Getting, when we get involved in the nuts and bolts of structuring these things, we are seeing that people are more interested in getting into the weeds of, okay, what happens if this scenario happens? What happens if that scenario happens? And both the buyers and the sellers of capital are interested in that. Perhaps focusing a little bit more on it than when everything is flowing freely and folks are competing for deals. And this goes to a point that a couple of you raised earlier, which is, okay, if we're all chasing after the 5 same deals, then guess what? We're not going to be as meticulous on some of those terms. Typically, this is what I've seen. If we're starting to deal with like, okay, let me look carefully at this company, or okay, this is kind of so-so, what is it going to look like in a restructuring environment? then the job of the lawyers in these things becomes an order of magnitude, I won't say harder, but maybe more important in terms of drilling down into the nitty-gritty of, okay, this is where we can put controls. This is where we need to watch out. If you're on the company side, hey, this can be a potential gotcha. We got to be wary of that. We got to figure out how we're going to manage that. And I don't know if you guys agree with it. I mean, sometimes, it's like you shove the things at the lawyers and say, deal with this. But a lot of you I know personally pay attention to the details. So thoughts?
Yeah, I think it's a combination, Constantine, of just indicative of just a deeper focus on diligence and quality, and just making sure, that the opportunity is exactly what you perceive it to be, kind of at all levels. I think the other thing too is, in this kind of environment, just speaking to kind of private, M&A type transactions, this is where creative structuring often is the difference between getting deals done and not getting deals done. And a lot of times that creativity or willingness has to be on both sides of the table, right? So I think that's kind of related and part of what you're saying as well, because getting down and trying to assess risk and maybe creatively structure around risk becomes more of a requirement when risk is more at the forefront of the discussion. So I think that's the other thing. Certainly last year, expect continues this year, which is, to help bridge the gap there between buyers and sellers. Creative structuring will often be needed in order to get things over the goal line.
And Constantine, I'm just thinking about what Jason was saying. You've been through so many of these cycles. Like you went through, the .com, the Great Recession. Like you've been on the investment banking side, lawyer side. Like, what's your advice for this season of where deal making is and where the market is? Like being through all that you've been through. Like what are some of the lessons learned that you can share?
I'm kind of old school. I echo everything that Alicia and Jason and Cesar have said, which is at the end of the day, you can't beat quality. And quality comes down to me is it a business? Is it well thought out? What are the margins? What are the growth perspectives? Right. And I've been involved as on the investment side, during frothy times of the market as well. And we'd get 100 different business plans, and people would come in and say, well, fund me. If you don't fund me, the guy next door is going to fund me. And you still got to stand back and look at it and say, does this make sense? Irrespective of whether there's 5 people desperate to burn up some of their dry powder, does this make sense as a business? Does it make sense to invest in it? So that's, sometimes you miss out on some opportunities as a result of that. But I think, instead of looking at a VC portfolio, instead of getting 1 home run and 9 failures, maybe you get 4 or 5 base hits and something else that amounts to more than just the 1 home run. And hopefully you get a few home runs in there too. But I don't know if that makes sense to you guys who are living through it right now in terms of how to approach this thing kind of over the long term.
I mean, you're just saying like the Warren Buffett approach, being diligent to wait for those pitches that you want, and not,
look,
and like not feeling a need to just swing at something because you feel like you're going to miss out on the FOMO, right?
Look, there's certain intangibles as well, right? I mean, if you have a really high profile sector like AI coupled with a strong IPO market, you know what? I may take a risk on a company that may not be as solid right now as it was, knowing that odds are I'll be able to exit out of this successfully because my friends at JP Morgan are likely to take this thing public, right? So it's not hard and fast. You got to look at the given environment at any moment. But at the end of the day, fundamentals matter, you know?
Yeah, I would say,
I-
so to piggyback on that, on the credit side. So we think about it in terms of risk-adjusted returns, right? And what can we do either with structuring or diversification or entry point to get a better quality return, even if a lower absolute return. So I'll give you guys an example of a deal we just worked on. It's a post-judgment IP situation. So there was an inventor who came up with a procedure to do genetic defect testing on pregnant women that was a lot less invasive than the traditional amnio procedure with the big needle that could cause a miscarriage, right? So he was able to sort of do this testing by blood work. This is a while ago. He started talking to LabCorp, Quest, the type of folks who should be interested in this type of patent to license it out. Those negotiations broke down. They stole his IP. LabCorp generated $1.5 billion in revenues, and said, "Come sue me," basically. So that's an uphill situation because those are expensive lawsuits to finance. You had to find a law firm that could that believed in the case and would take it on contingency, and he did, and they won. They got a $400 million judgment after a long period of time. We were able to get a tower of insurance companies to insure half of that judgment and insure it against appeal risk, right? Because you won the judgment, but they can appeal, so ultimately you can lose. And we made a loan to the company at a 50% LTV to the insurance so they could pay the premium, which was expensive. It was about a 15% rate online. So a $30 million premium to get the insurance. They got a $100 million loan. The other 70 million they pocketed to monetize sort of the judgment. So we could have made that bet, without insurance and gotten a multiple of money, a more binary type situation. But with structuring, with insurance, we think we got a better risk-adjusted return, lending the money at a 14% rate, right? So in a market like this, I think generally you want to try, sort of back to the quality theme, to not swing too hard, to think about downside protection, and do what you can to get a better quality risk-adjusted return.
Agreed. And Alicia, I think you were going to say something as well right before.
Yeah, I was going to say definitely quality. Not that there wasn't quality to diligence before, but definitely deals that are coming through my fund right now. We have time, and that was not always true. Like the hottest deals in even like summer 2022, they'd often come with an email that was like, you have to decide by Friday. I've got 4 other investors willing to take your spot, and I need a commitment, and I need so like we would just do everything we could in whatever number of business days we could to look at the books. But now there isn't that level of frothiness, and people aren't making those threats. And so we are being able to do our full diligence process on every deal that comes in through the door that we're interested in. When I would say in like 2021 and first half of 2022, maybe like a third of the deals that we ended up putting money in, we weren't able to do our full process because they were the quote unquote hottest deals of the time, the prettiest girl in the room. And they acted like they didn't need us because they didn't. And now the deals do.
Wow. Such great insights. That's great. Were you going to say something, Jerome?
No, I said flipped. It's fascinating that it's so flipped, but it's in the the VC's favor now. This is going to be generational kind of returns for the investments this year and this vintage.
All right. This has been amazing. Such a well-rounded discussion we're having, you guys. I want to go ahead and open it up to our Q&A. We've got some great questions in the queue. And again, whoever has maybe some insight into this, would love to just have you jump in. Darren says, given global conditions and given overlap of space and defense, any comments regarding those verticals from an M&A perspective or venture perspective?
I will say, and my fund does space and defense deals,
Oh, really?
still
Okay.
hot. I would say relatively hotter. I think some of the shine has come off of, say, consumer and has been replaced by the strength. And I think like just resilience of these sectors. These are definitely, it's not a one-to-one replacement because they're just, the market dynamics are totally different. Like in consumer, you've got, you know, relatively low risk, relatively very short timelines, and also like relatively lower multiple potential. And for space and defense, you've got super long timelines, and it can be like really binary. Like you get this government contract or you don't. You get this Lockheed contract or you don't. But if you do, it's 86 million for their first PO or something. So I think that in a different environment where you don't have like the satisfaction of quick wins from consumer brands that can say in like 3 to 4 years exit, like start and exit, there's been renewed interest in space and defense, and some of our original investments in those areas are just starting to land their first big contracts or go through and like create their first, like for space, their first like machines and flights, et cetera, and do those test launches. And so we're starting to see traction there, and that's been a really positive sort of buffer to the choppiness on the consumer side.
Let me add to that, if I may, from the perspective here in Austin, where we have in Texas generally a big military population, but also this technology concentration in Austin. And what I've seen over the last few years is a real kind of start of interest out of the government and military sector for new technologies, smaller players, etc. For anyone who's not familiar with the sector, it's been dominated for many, many years by a handful of big defense contractors. And consolidation amongst them. There's only been one kind of new big defense contractor that's emerged over the last few years, and that's kind of an oddball. It's Palmer Luckey's new company. Palmer Luckey was the developer of the Oculus that Facebook bought, and he moved into the defense sector and is really kind of hitting it big there with a lot of technologies that are being integrated, drones and VR and a lot of things that have applicability. But what we're seeing at the local level, when I got here a few years ago, DIUX, Defense Innovation Unit, had opened up an office here, which was looking for companies in smaller emerging companies that had defense applications, and they were coming up with new contracting vehicles because, to Alicia's point, defense contracting is a big complicated process, and getting DoD to write a check was usually a big complicated process. DIUX was looking to streamline that by looking at OTAs, other technology. I forget what the acronym stand for, but it was an easy way for them to write a check. Since then, we've seen AFWorks come in here, Air Force Works, Army Futures Command come in here, and they're all looking at new technologies, new companies, smaller companies, things that they can integrate into the overall military readiness and modernization process. And it's kind of an exciting time in that field. I mean, there's still, usually the path is you start there, then you glom onto one of the big contractors, which has a big prime contract with the government. But it's much more agile than it's been in a very long time. And Alicia, I don't know if you're seeing the same kind of talk amongst the companies that you're funding in this sector.
I don't think I'm as close to it as you are, but I can definitely see that happening.
So
I mean, we're an
okay.
early stage fund, so we're
Okay.
certainly backing the upstarts and hoping for that.
Yeah, and so we have a manager, Enlightenment Capital, that's very active in the defense space. And it's been good for a while. A lot of the sort of political instability, wars, that's all good for business. But one thing to be mindful of is just generally the FTC's posture to consolidation in the space. A lot of deals are being challenged. They're not necessarily winning a lot, but Lena Khan, the FTC, everything seems to be harder to sort of get through. So, something to be mindful of, even in a sector that I think is hot and has a lot of tailwinds. There's a concerted effort by the administration to sort of be mindful of consolidation and limit it wherever they can.
But it takes a while to get to that size, typically, right? I mean, we're talking usually big consolidations, big mergers.
Yeah, I mean, so these guys, you'd be surprised. So this is a PE firm that does some private credit and some private equity lending, and these are private transactions, not even public transactions, $400 or $500 million type sizes, and you're seeing interest from the regulators where you
Yeah,
weren't
true.
before necessarily. So
I will say it's a very active administration, and so we'll see what the elections hold, but they've been very active, even going after, type of private equity for roll-ups and kind of like, threatening different things. So I think to your point, it's something to note of the regulatory environment. It just adds extra, deal costs. Even if you, like you say, even if you win, you still have all those deal costs that, get added onto it, the time and everything else.
yeah, and we haven't talked about the election much, but the uncertainty around November, that's a big thing, right? And it's going to have a bunch of knock-on effects either way.
We have one more comment / question in the chat. Says there are other reasons that deal flow is down, and it has to do with the dynamics on how VC funds are structured and how they function within the larger capital flow market. It's harder for them to raise money for the next funds for a myriad of reasons, but as such, many have delayed plans for raising their next fund. So in order to save face and to maximize their ability raise, it's advisable for them to slow down deployment. Can you expand on this?
Alicia, are you slowing down the deployment?
yeah. No, we're not. We're not. We were almost fully deployed, sort of even before the macroeconomic downturn. So certainly not. And I'm processing, like, I could see funds doing this because as long as they're still deploying capital, they're still actively involved in a current fund rather than having been deployed and, say, sitting on their hands. Because maybe if you've already actively deployed all your capital, then it becomes more apparent the sort of timeline of holding off raising the new fund. Is that the idea? That's what it sounds like.
It sounds like maybe, it sounds like to me, like, if you think you can't raise and you slow down deployment, maybe it allows you to stay in the market longer versus being fully out of powder. But
yeah, I could see one other reason, like if you're trying to pump your IRR numbers, the later you put the money in, then you have, less time that you're calculating against for the gains later.
Yeah.
So I guess I could see funds doing this. I don't know how useful an exercise it is to think about this, because it's not like an LP can extract their money or force a fund's hand.
It's also interesting too,
particularly unfortunate for companies.
It's also interesting too, because we're dealing with this is where, let's say you have an LPAC, a limited partnership advisory committee, and depending on how much power they have, but let's say your fund is, I don't know if it's a 10-year fund or 8-year fund, typically, you're gonna, as a GP, you'll have a couple of years where you can just de facto extend the fund, but then after that you need the LPAC vote or whatever it is. So I could see a scenario where, maybe it's a, let's say 6 or 8-year fund and you've got a couple of years left, and you can unilaterally extend that window without needing, like you're saying, the majority of LPAC approval. So I could see that, them extending that, like you're saying, keeping in the market, maybe being diligencing deals and kind of like hoping for some exits to create some returns that would inspire confidence in LPs to want to re-up for the next fund if you're having trouble now. But yeah, it definitely seems like I could see it happening. I know, I could see it. I definitely could see it.
Typically, though, you'd want to deploy, if you're seeing good deals and get the money out. If you get it out, in theory, you should get it back faster. You can recycle it. You can do more. You can get more of a MOIC in the fund.
That's right.
So, maybe if you're really distressed and have no ability to raise money, you want to do some of that, but it's not really what you want to be doing.
It's tough.
Ideally.
It comes back to Jason, your point, where there's the secondary market for GPs. Like we've seen this, like GPs coming to us and saying, hey, I got a GP that wants out of their stake. And there's a, I know different companies. I know Bernstein, has a company that does secondaries, and there's companies just focused on this. So, if they're trying to raise capital because debt is so expensive, especially in the PE world, I could see that. They're trying to raise funds and figuring out how to just continue. But Cesar, you make a great point. Like the earlier you deploy your funds, the quicker you're going to get the return. So you're that's really incentivized not to wait so long. So there's kind of a catch-22 there. Let's like a dance.
Yeah. Maybe in a more optimist view, those funds are actually holding and waiting for who ends up being the survivors out of the frost right now. That could be.
I think the conclusion, of this discussion is that if you have quality companies using kind of the metrics that we've talked about here, it may be a little bit more difficult, but there's still capital out there looking for these opportunities. And the same goes for the funds. If you've managed to make good investment decision, if your portfolio companies are showing good metrics, even though you don't have necessarily an exit, then you're in a good position to raise additional capital for fund 2, 3, 4, 5, whatever the case is. But that's, that's kind of business common sense. We are in a more difficult environment, so, quality is going to stick out even more than it usually does.
Yeah, and I think it's one of those natural thinning of the herd kind of periods, right? That started last year, and so much money was thrown at a lot of things that ultimately were probably not good decisions. And I think one of the I'd say arguments that a lot of people make, kind of in favor of the Fed raising rates, kind of trying to reduce the amount of free capital in the system, and is some of that thinning. It's kind of healthy for economies to go through that. It's not necessarily healthy for interest rates to be at zero for decade after decade. And so, but it's been a while, since people have gone through that type of cycle. So it's new for a lot of people. And, but to be honest, just as far as cycles go, it's been pretty mild in terms of the carnage so far. As Cesar mentioned earlier about things breaking, there were a lot of people calling for a lot of things to break last year and that didn't break and haven't broken yet, and feel like maybe they won't break if we get the quote unquote no landing, soft landing scenario that feels like it might be on the table. So I think everyone will have come out pretty easy if that's where it goes for now.
Let me just say, having lived through 87, 2000, 2008, things are pretty darn good right now, all things considered. So, yeah, I will echo that, Jason.
Well,
That is true.
We could end that right there. Thank you everyone so much for your time and for coming to the 2024 M&A and Alternative Investment webinar. Thank you to all of our panelists. Thank you so much. We're so grateful for your time and your expertise. To all of our attendees, we have recorded this, so we will go ahead and send this off to you. Please feel free to share it with anybody you think can benefit from this. And please visit us at fpgeneralcounsel.com if you have any further questions regarding this webinar. Hope everybody has a great day.